Happy Friday from all of us here at StablePoint Partners. I wanted to take a moment and share with you our thoughts here on the week in the markets that was, and what a busy week it was with tariffs going into place in full force and a definite return to market volatility with the Dow Jones Industrial Average having a significant swing here on Thursday this week. I wanted to share with you our thoughts around what's going on. So I'll get right to it. Number one, tariffs definitely not catching us off guard or coming from out of left field. We've been talking about this now for quite some time. However, in the range of possible tariff scenarios, this is definitely the most aggressive, where we had talked before about tariffs as moderate, as potentially a bargaining tool, to as severe as going in force in full. It looks as though they're going to be on the more severe side of that pendulum, and we should expect those to be going in force now moving forward and potentially staying in place for some time. So, what does that mean for the economy? What does that mean for spending? What does that mean for prices and inflation? And honestly, what does that mean for the investment portfolios that we've built that are designed to withstand this long term? So, with that, I actually want to go back and take a look at 2018 for a minute. I'm going to call that Trump 1.0 during the first term of the Trump administration, and we'll compare that to today. I'll call that Trump 2.0 and the tariffs that have been announced and some of the policies that are going to be going into place here in this administration. So let's talk a little bit long-term perspective around financial markets, and let's take a look now at a chart from the S&P 500. I'm going to use the ETF SPY that tracks that as our barometer in this chart. And if you remember 2018, it was a series of tariffs throughout that year, primarily on China, but they were centralized around September 17th that year, where Trump put in place tariffs of 10 to 25% on the vast majority of Chinese goods coming into the United States. Markets did not like it at all. Markets were having a very good year. They had just come off a really good 2017. However, that did spark a pullback in the markets, very honestly similar to what we're seeing today. And in 2018, we saw markets decline. I'm going to call it 20%. It was just less than that. And they bottomed out on Christmas Eve. And I'll share a news article with you from that time. I'll never forget that day. That's a shortened day on Wall Street. I worked from home. I was in my home gym. And after 2.5 months of a tough market, to see the Dow down 650 points on Christmas Eve, it was a little bit crushing. Didn't know it at the time. That was the bottom of that market pullback. The worst was behind us. And literally into the last week of December, markets started to recover, lost ground, and move back in the right direction. So I really want to hone in on Trump 1.0 tariffs because I think they give us a little bit of a playbook for where we're at today for time horizons, severity of market pullbacks. And if we had a dollar invested on September 17th of 2018, it was worth less a month, 3 months, 6 months later. However, after a year, markets were higher by 5.5% in the S&P 500. 2 years later, our dollar was worth $1.20, 20% cumulative return. And after a 5 year period of time, our dollar was worth $1.67 or 67% cumulative rate of return over those following 5 years. Again, that's not from the bottom of the market, but from the top before the tariffs were announced. So I think that gives us a little bit of precedent specific to Trump, specific to tariffs, on what we might potentially expect out of the market environment here moving forward. And with that said, we may see volatility persist for a little while. We are now already a couple of months into this market pullback. In 2018, it was that tariff announcement that started the market pullback. We've already started this for a while now. So going into an environment like this, we just want to be patient. This isn't a time to panic. Frankly, it's a good buying opportunity for those that have a longer term time horizon. But we want to know what we own. We want to have a good time frame to stick with it through the ups and the downs. So let's take it a step further. We've had this question a lot from clients. I'm sure that it's going out there as well. What if this turns into a longer term bear market situation where it does not look like Trump 1.0 back in 2018. Well, let's talk about that for a minute. I bring us now back to the lost decade, the 2000s. This was a drawn out bear market. Started off with the technology bubble in 2000, ended with the great financial crisis in 2008. During this period of time, one of only two periods of time in our country's history where the stock market had a negative return for a decade. Only other time that happened was the Great Depression. So if you had a dollar at the beginning of that decade in 2000, 10 years later you had 90 cents. Very, very difficult period of time. However, if you took that same S&P 500 index and didn't own it the way that it existed then, but you evenly weighted it, you had 0.2% in each of the 500 companies, well, your dollar at the end of that decade was actually worth $1.60 or $1.70. You generated a north of 5% a year average annual rate of return. And although it's not the most exciting of decades, you were still able to grind forward and make really good forward progress. So what does that mean when we look at the lost decade, when we look at Trump 1.0 in 2018? What that brings us to today, honestly, is some of the very things we've been talking about now for months. Stay evenly weighted in your portfolio. Don't get top heavy like the market. Rebalance your portfolio at least twice a year. This may be one of those years with the extra volatility where a third rebalance may be prudent. Avoid areas of the market that are overvalued, that are speculative, and have had a huge run up. For the last few months, we've highlighted the Magnificent Seven, some of the tech names, right? They've had a significant pullback since that period of time, and they're starting to get to a point where there's probably some buying opportunities there as well. So as we go forward, a couple of thoughts. One, probably going to see markets stay volatile, both ups and downs here for a bit. When you have volatility like this, it does take a few months for that just to settle down. Two, continue to do, as we've talked about, with staying evenly weighted, rebalance. For risk-averse investors, don't forget about dividend-paying stocks, which are making it through this environment with significantly less volatility than the market as a whole. Don't forget about bonds, right? Interest rates have dropped by over 0.75% in the last 3 months. That's been a real positive for the bond market, and it's pushed the bond market up 5 or 6% in the last 3 months. This is positive for investors in bonds, but it's also a great thing for borrowers. So if you have a mortgage or you got a mortgage in the last year or two, it's probably a good time to look at potential refinance rates. So longer term, as an investor, definitely not a time to panic. It's also not a time to get greedy. We want to stay evenly balanced, evenly weighted, and make sure that we're defensive in our posturing to get us through the environment ahead. And like the lost decade, if we stick to those fundamentals in the short term and the long term, you have great opportunities for success with your investment portfolio. As always, I'm here. The team is here for any questions that you have. Reach out anytime. If you have friends, family, colleagues that have questions right now and are concerned with what's happening in the markets on the other side of tax season, we're more than happy to connect with them and help in any way that we can. And in regards to tax season, week and a half left until the tax filing deadline. Please reach out to us if there's anything that you need. Documents to you, to your CPA, questions that you have. We're here to help. As always, thank you for your trust, your confidence, your advocacy in us. It means the world to us. And we look forward to talking with you soon. Have a wonderful weekend.